Good afternoon, ladies and gentlemen, especially our attendees who are based in Turkey. I know some of you in different jurisdictions. It might be morning where you are, it might be evening, but good afternoon, good morning, good evening to all of you. Welcome to the Actuaries in Banking webinar that is being hosted by the IAA Banking Virtual Forum in collaboration with the Actuarial Society of Turkey. We really appreciate your attendance and taking time to come and listen to us here today. So please stay tuned. I would like to introduce myself. My name is Michael Actuarial. I am a familiar face to some of you, but for those of you who don't know me, I qualified as a fellow of the Institute of Actuaries in 2004 and a fellow of the Actuarial Society of South Africa. And I moved into banking in 2008. So since then, I've been doing a number of banking assignments. I also would like to introduce our panelists that we have here. The first panelist I would like to introduce is Mr. Sezai Sefkin, who is a banker, has been a banker for a very long time. So Mr. Sefkin is a Deputy Chief Executive responsible for risk management, corporate compliance, internal control, and information security at East Bank, which is the largest bank in Turkey, with a consolidated asset size of 1.2 trillion Turkish lira. And it owns the largest distribution franchise countrywide, and there's an international presence in 11 countries with 21 branches, 2 representative offices, and 3 banking subsidiaries. So more about Mr. Sefkin. Having started his professional life in East Bank in 1990, which is a long time ago, Mr. Sefkin has served as an inspector, branch manager in domestic and foreign branches, has been the group manager of the corporate marketing, head of commercial marketing division, and took senior management roles in various group companies throughout his career. Please help me welcome Mr. Sefkin, who is one of our panelists. You can see that he's a banker, has been a banker for a very long time. I also would like to introduce Mr. Ian Allen. Mr. Ian Allen is going to talk about his career in banking, where he will give examples of where actuaries can use their skills and experience within the banking space. More about Ian. Ian was Group Director Strategy at RBS, which is now known as NatWest in the United Kingdom, for 15 years. He has subsequently worked as an independent consultant in banking. Ian is also an honorary visiting professor in the Faculty of Actuarial Science and Insurance at Bayes Business School in London. So those are our 2 main panelists. Mr. Sefkin will start and he will talk about banking so that you can understand, me being a banker. Then we are going to have Ian Allen also coming to talk about actuaries in banking, his own experience and where actuaries are involved. But before we start, before I invite Mr. Sefkin to speak, the president of the Actuarial Society of Turkey, Ms. Shisat Setikaya, would like to say a few words about the Actuarial Society of Turkey. So I'm going to now invite Mr. Setikaya, or let me just say Shizat, to come and speak to us. Welcome, Mr. Setikaya. I give the floor to you. Thank you.
Thank you very much. Actually, welcome to everyone. I want to start my speech. That will be a very short speech. I especially thanks to Mr. Taylan Matkap, actually who is representative of banking forum in Turkish Actuarial Society. He supported us very much. And I also thanks to Mr. Michael and Ian, actually being a part of that event, and we took valuable support from them. Ms. Nancy and Eileen, actually we took their solution-based approach and cooperation. And lastly, IAA, actually, thanks to their support. As you see, Actuarial Society of Turkey has established in 1951. He has long history. When I come to the number of actuaries in Turkey, there is a jump, especially when we check the past 10 years. Almost the numbers doubled and 2 times. In 2012, there were almost 200 actuaries in Turkey. But now we are facing 400 actuaries. Let me come to our society. We are the member of European Actuarial Journal, and we are the full membership International Actuarial Association, and we also full member of Actuarial Association of Europe. We have strong communication with other parties, such as International Actuarial Association, European Actuarial Journal, Actuarial Association of Europe, universities, insurance companies, Insurance Association of Turkey, Ministry of Treasury and Finance. We have 250 members, actually 142 coming from full members, and others are honorary members, observer members, student members, and supporter members. We are trying to do many things, especially for the social responsibility side. We have a library. Actually, we have a resume pool for students that looking for internship and people that looking for a job. We also supporting universities. Actually, actuarial education is really important for us. We are attending career days, giving actuarial lessons, and giving feedbacks to university syllabus. We have also representatives at International Actuarial Association, Actuarial Association of Europe, European Actuarial Journal, Insurance Associations of Turkey, Actuarial Exams Board, and universities. We are also trying to do seminars, conferences, such as to update our know-how and increase our knowledge. Some of them you are seeing: the climate risks and sustainability, recent academic developments on data analytics, and our language in insurance. These are the main our activities. Again, thank you very much for listening to me, and welcome to our seminar.
Thank you very much, Shehzad. I can see that there is a lot of work you are doing there in Turkey, growing the membership, the education initiatives, CPD events. I think that's very good. I would like to think that as you proceed, you will also start to encourage and develop competencies for actuaries to move into banking, which is quite an exciting area. So thank you very much for that. Thank you. So now as we move on to all attendees, I would like you to keep in mind and thank Nancy Kelly and Amalisen Frantine for helping us with all these webinars that we hold. So this is great. The ladies have been of great support. Now I would like to invite Mr. Sezai Sefkin to now give us his presentation so that you can understand a little bit more of what happens in a bank, especially for those of you who have not engaged banking activities. Mr. Sezai Sefkin, I would now invite you. I give the floor to you. Thank you.
Thank you. First of all, I would like to thank IAA and the Actuarial Society of Turkey for having me in this event. As a person who builds his career in banking sector, I'm very excited to address to the participants from the insurance sector and the actuaries who have deep technical knowledge and analytical skills and background. As we all know, banks play a central role in economic growth of a country. This argument is especially stronger for emerging countries like Turkey, where capital markets are relatively shallow and the access to funding sources is limited except the bank loans. So, in most of countries, banking sector is regarded as one of the strategic sectors. In simple terms, banks are often defined as a medium between the parties with excess funds and the parties who requires them. This act of intermediation is not an easy task. During this intermediation process, banks at the same time transform the maturity of the funding and relieve the default risk from the fund providers. When we look at the balance sheet of banks in emerging economies, we see that commercial banks obtain short-term funds, especially in the form of deposits, and convert this into long-term assets like investment loans or mortgages. This process, no doubt, brings efficiency and boost to the economy, but at the same time creates credit risk and maturity mismatch risk to the bank itself, which should be managed carefully within a systematical risk management framework. As we all know, even though banks and insurance companies have some similarities due to both being financial institutions, actually their operations are based on different models. Both insurance companies and banks are subject to capital regulations. Due to their different business models, the risk that banks and insurance companies face are different. For instance, insurance companies' liabilities are more long-term. However, banks are more susceptible to run by depositors. When we deep dive a little on the main risk types that the banks are exposed to, firstly, banks should ensure that the loans they extend to their customers will be collected without any loss. This issue is related to well-known and the primary risk that the banks face, namely credit risk. Secondly, timing of the assets and liabilities, cash flows, do not coincide most of the times. I have already mentioned the maturity transformation mission of the banks. In order to fulfill their payments at any time, banks should keep an adequate amount of liquidity at hand, which means they should form a solid liquidity buffer, which consists of high credit quality assets that can easily be converted into cash, even under stressed financial conditions. As it is seen in the global financial crisis in 2008, acting otherwise may produce system-wide liquidity problems, and liquidity sources may drop up very quickly, which in turn may lead to bank defaults. Third important risk that banks face is the interest rate risk. As we are all aware, changes in interest rates affects all institutions, and banks are no exceptions. But in order to be sure they maintain their margins and economic value of their assets, banks should monitor their interest rate exposure and manage their sensitivities against the movements in interest rates. Banks not only lend the funds they borrow, but depending on their business model, they may also be investing on their own behalf or engage in trading activities to benefit from market fluctuations. However, movement in market risk factors may lead to losses as well as profits. Therefore, market risk, which is the fourth important risk type that banks are exposed to, should be monitored and managed properly. Apart from these main types of financial risks, banks also face non-financial risks, such as operational risk. Depending on banks' own risk definitions, this risk type can be divided into a number of subcategories, such as internal fraud, conduct risk, IT risk, cyber risk, compliance risk, and so on and so forth. Almost all sectors, including the insurance sector, are exposed to similar non-financial risks. Physical risks of climate change become more tangible day by day. So, for the insurance industry, it's inevitable to consider those risks in almost all steps of decision-making. There are many more non-financial risks, such as fraud risk and vendor risk. So, a complete understanding and sound management of non-financial risk are very important for building a resilient insurance industry. The changes and developments fueled by digitalizations and technological progress on banking and payment system have become one of the main strategic priorities of banks. Naturally, this rapid change and transformation in technology has brought IT risk, cybersecurity risk, and data protection risks. In this area, as we all know, there is a talent gap in the market at a global scale, and especially having sufficient people, both in terms of expertise and quality, has become a challenge for banks. Of course, this people risk is not only related to IT and cyber-related risks. Accelerated with the destructive impact of the pandemic, we have observed major changes in the conventional labor market, as well as which lead to a significant increase in the mobility of people and turnover rates experienced by banks. This phenomenon, called the Great Resignation or the Great Attrition, is amplified by the depreciation in the Turkish lira, and it has become one of the most important risks that the Turkish banks face. In addition to these risks, climate change has become one of the major global risks that threatens the sustainability of human life, as well as financial stability due to natural disasters, water and food crises, and migrations waves it may cause. For banking industry, the transition process to a low carbon economy will have significant impacts, especially on credit and liquidity risks. Recently, the Basel Committee has published its principles for the effective management and supervision of climate-related financial risks. Of course, this is an exhaustive list, and the banks can face different types of risk depending on their business models. However, I can confidently say that these are the most common risks that the banks are exposed to. In order to avoid social cost and financial burden on taxpayers, banks should have the strength and capacity to assume all the risk they face during these operations. For this reason, all around the world, the banks are heavily regulated and monitored closely by specially mandated regulatory authorities. For Turkey, this regulatory authority, namely Banking Regulation and Supervision Agency, BRSA, was founded in 1999, and especially after the local crisis in 2001, this institution has been empowered and mandated to move the Turkish banking system towards international standards. If we look at the brief summary on the implementation of the Basel rules in Turkey, we see that with the extensive efforts and collaboration of BRSA and the domestic banks, the Basel II capital framework came into force in 2012. 2013, the capital accord has been updated to include Basel III standards with a transition period till 2019. In 2015, Basel Committee conducted regulatory consistency assessment program in Turkey. During this assessment process, the BRSA issued a set of amendments to align its domestic regulations to international standards. Based on the amended regulations issued in 2016, Basel Committee assessed Turkey as compliant with the Basel risk-based capital standards. Currently, the Basel framework applies to all credit institutions, including commercial and state-owned banking institutions, on a bank-only and consolidated basis. Let me now go into a little more detail on approaches to calculate the credit risk capital requirement, as it is the main component of the capital adequacy ratios of the banks. According to the capital adequacy regulation, banks are required to calculate the credit risk capital requirements on a solo and consolidated basis, either using the standardized approach in which the risk weights are determined based on the obligor's risk class and external rating, or internal rating based IRB approach, where the capital requirement calculation is based on the estimation of credit risk parameters such as probability of default, PD, loss given default, LGD, and credit conversion factor, CCF. İşbank, like almost all other banks in Turkey, calculates and legally reports the capital requirement for credit risk via standardized approach. On the other hand, currently we are using IRB approach in the internal capital adequacy assessment process, ICAAP. Besides, we as İşbank recently have made an application to the BRSA in order to get a permission to use IRB approaches for regulatory capital calculations. Hopefully, we will soon be able to use our internal risk models in calculating the regulatory capital. In IRB approach, credit risk is modeled using widely used statistical techniques. Although minor variation exists, PD, LGD, and CCF models are also used in the IFRS 9 loan provisioning process. IFRS regulations has been in effect in Turkey since the beginning of 2018 and changed the way how banks quantify the expected credit loss. Before 2018, expected credit loss was calculated based on standard ratios specified by the legal authority. After IFRS 9 has been put into force, banks built or leveraged their existing credit risk models and started estimating their customers' expected credit losses. Different than the capital adequacy framework, the risk parameters used in expected loss calculations reflects the current macroeconomic cycle and contain the bank's forecasts of macroeconomic factors into the future. As I mentioned earlier, one of the most important risks that the banks face is liquidity risk. Obviously, lenders want to collect their money in a short amount of time. However, usually borrowers' choice is to pay their debt as far as possible into the future. So, liquidity risk is defined as the risk of inability to meet payment obligations in a timely manner when they become due, or inability to provide funding at a sustainable cost. In the aftermath of 2008 global finances crisis, liquidity risk gained the importance it deserved. Basel Committee published a number of principles for sound liquidity risk management and introduced two primary liquidity risk metrics: liquidity coverage ratio, LCR, and net stable funding ratio, NSFR. LCR focused on short-term liquidity risk and demand the banks to have enough amount or high-quality liquidity assets to compensate their net cash flows, which will occur in a 30-day horizon. On the other hand, NSFR's focus is on stable funding and longer-term liquidity. LCR is in effect in Turkey since 2015. For NSFR, a draft communique is published in 2018, which is recently revised in 2020, and is expected to be in effect in a short amount of time. Obviously, most of the systemically important banks in Turkey, including our bank, are calculating NSFR and adopted this metric in their risk appetite frameworks in advance before it has been translated into international law. In today's world, big data and machine learning techniques has become one of the important tools in decision-making processes of the banks. In this respect, as ISBank, we eagerly use AI models and big data-related technologies to adapt to this new way of working where speed is essential. While having several benefits, if not properly managed, these new decision-making tools may be a source of risk themselves. Those models are required to be managed within a sound model risk management and validation framework. In order to effectively manage the model risk within our bank, firstly, we have created a model risk policy and a model inventory, which contains all the available models within the bank. Secondly, as you all know, since the models are not of equal importance, we have created a tiering system in which we assess the models according to their importance and complexity and perform the validation studies with a risk-oriented perspective. For effective model risk management, validation activities shouldn't be limited to quantitative validation. A more holistic approach containing the review of models' conceptual soundness and its use in the bank's process is an equally important. Model life cycle are regularly monitored within the scope of the holistic management of model risk. In ISBank, aside from risk measurement models, we have pricing, economic forecasting, underwriting, credit monitoring, marketing model, etc., reaching around a range of 130 to 160 models. Approximately 35 to 40% of the bank models include machine learning algorithms, particularly modeled with gradient boosting algorithms. AI models use big data with more than thousands of features used in modeling. Moreover, among third-party models that the banks is using, AI algorithms are commonly used in the natural language processing NLP models for speech, face, or text recognition. Also, banks benefits heavily from the services and models provided by fintechs, especially in areas like marketing, for instance, next product to buy, and cybersecurity. When we consider the insurance sector, like the financial community as a whole, the use of artificial intelligence is also common, especially in damage recognition models. As for catastrophic models, which is generally modeled as earthquake risk for Turkey, validation needs to be handled with the special customized techniques. So, taking into account the time allocated to me, let me stop at this point. With this introduction, I believe I was able to give you the flavor on the topics that we are dealing in the banking and risk space. Thank you.
Thank you very much, Mr. Sevkin. And when I was listening, I think you could see that I was smiling. You have essentially covered the end-to-end of banking where actuaries need to be involved. In fact, what I did, just to recap, I did summarize some of the points that I'm going to highlight now. And I would like all the actuaries and actuarial professionals listening with us here to take note of these. You have essentially just covered what actuaries should be looking to be involved in. So thank you very much. This is excellent. If you have any questions that you'd like us to ask Mr. Sevkin, you can ask them in the Q&A box, and we will attempt to answer those questions at the end. But I would like to summarize before Ian Allen, who is actually the Deputy Chairperson of the Banking Virtual Forum of the IAA, before he comes in, I would like to summarize in a minute or two what Mr. Sevkin spoke about. So introducing banking, how banking is important, the business of a bank, being maturity transformation, taking short-term funding and lending it long to borrowers, and then the banks playing an intermediation role in the economy, the differences between models for banking and insurance, even if there are similarities, which I'm sure Ian Allen is going to speak about as well, but the business models are different. Then emphasis on risk management in banking, highlighting the different risks like credit risk, operational risk, and of course, not to forget liquidity risk, which is actually a major risk, market risk, and many other risks like cyber risks, even climate change risks that are actually being introduced into the equation. All of those areas actuaries can play a big role. And the transition to the carbon efficient economy, I mean, that's another big area that you've spoken about. And all of these risks require specialized skills, which actuarial professionals and other professionals can provide. You spoke about Basel implementation in Turkey, and you also spoke about standardized models and the internal ratings-based models that you are also applying to the Central Bank of Turkey. All of those use statistical approaches in order to calculate capital for all the different risk areas. And these are areas actuaries can be involved. You spoke about IFRS 9, provisioning for expected credit loss. Again, the same parameters of probability of default, loss given default. We use statistical approaches and even cash conversion factors. So that's excellent. And then you ended up talking about the importance of big data and machine learning, artificial intelligence being used, and that in its own introduces new models that can come with risks, which means management of risks in banks is very, very important. And that requires effective risk management or model risk management. Model validation is very important. You also say you have got a unit within your bank. All of these areas are areas actuaries can come and get involved in. So thank you very much. I think it was excellent. I was smiling. I said, if anyone is listening in here, you can see that this is exactly the work that actuaries possess. Some of the skills you can apply. I think with that, once again, thank you, Mr. Sevgin. It was a great presentation covering end-to-end of banking and risk management. I now invite Ian Allen, who has been in banking for more than 30 years. He can now come in. Ian, I now yield the floor to you. Thank you very much.
Thank you, Michael, and good afternoon, everyone. So thank you to Mr. Sevgin for his very clear explanation of banking. He's spoken about banking from a banker's point of view. I'm going to talk about banking from an actuary's point of view. So, like Mr. Sevgin, I've been in banking for 30 years. But unlike him, I've had 3 different careers within that period, working in investment banking, universal banking for RBS doing strategy, and subsequently retail banking as a consultant for new entrants. And when I look back at these, I've enjoyed each of these, quite different, really good, really interesting. They demonstrate, as well as the obvious focus in risk management, there are many interesting things to do in banking, many things, problems to solve that are of interest to actuaries. However, we know that actuaries are often rather cautious or risk averse, and people often ask me, what was it like working for a bank? Did bankers understand you? Were you able to use your skills? And I can say with no doubt at all, in each of these 3 parts of my career, being an actuary has been very well received by colleagues in the bank, by regulators, and when I've been involved in joint ventures, by partners. And as you would hope, the expected qualities of being technical competence, Mrs. Sevgin talked about the model development and validation and so on. You assume actuaries can do that. Integrity, because we operate under professional code. I would sum it up as reliability, just can you do the job and get it done properly? Here, from an actuary's point of view, is a snapshot of a bank. As Mr. Sevgin said, in a typical bank, traditional bank, the main assets are loans, the main liabilities are deposits. 3 main risks are credit risk, operational risk, and market risk. And below, we need to manage across all risks, not just these three risks, but all the risks Mr. Sevkin mentioned, capital and liquidity. So the business model is different. But for us as actuaries, all these terms, credit risk, capital, liquidity, we are familiar with them. The mix is different here. As Mr. Sevkin said about the maturity transformation, when actuaries come to banking, an important thing to understand is that assets and liabilities are not matched in the same way. And this creates this important liquidity risk, which was so much of a worry in the banking crisis of 2008. It's also a little complicated because behavioral maturities are different from contractual. In the UK, many people repay mortgages early. Many deposits have no fixed maturity, but may last a long time. So these are areas which are very understandable to actuaries. What may be new to actuaries from an insurance background is the sensitivity of credit losses to the economic background. Over economic cycles, credit losses are lower and higher. And in terms of systemic risks, banks can amplify that. In the unforgettable banking crisis of 2008, with hindsight, banks amplified the risks with easy lending and a bubble in house prices ahead of the crisis. Afterwards, they cut back in lending and made the recession worse. So they amplified the up and they amplified the down. But happily, under COVID, there had been no boom before COVID, and regulators have been very effective in many countries in pointing out to banks that they should keep lending, because if they stopped, they would have a worse recession and worse bad debt. So banks do contribute to economic growth, and their future is linked to the economy and can affect the economy. Actuaries often ask me, why would you go into banking? One very obvious reason is that banking is a large part of financial services. In America, bank insurance may be roughly the same size. In many other countries, banking is a much larger part of financial services than insurance. One main reason to be in banking is its centrality to the economy. The other main reason, I would say, is the amount of data available. And I'm really impressed by what Mr. Sevkin said about the number of models they have and the extent to which they're using AI and ML in these models. So these two central points here mean, as we move to a digital age, because of their importance to the economy and the amount of data, banks will change but have a secure long-term future. And then my final point here is, although the business models are different, although the language is different, banking is not that different from insurance. And on the next slide, I list 6 specific areas where people can move from insurance to banking quite easily. Product pricing, very similar. Different products, different business models, but the principles are the same. The second one is really important. As Mr. Sevkin said, banks are now using IFRS 9 to estimate their credit losses. Many actuaries have years of experience in doing something similar in reserves for claims. So actuaries in many countries, as employees and as consultants, are working on expected credit losses. Model development and model validation, that's a main part of our lives. And as professional risk managers, we understand the processes relating to model development and model validation as equally important but separate tasks. Asset liability management, because of liquidity risks, it is different, but the principles we studied in our courses about asset liability management are very relevant to the management of asset liability risks in banks. And finally, bring it all together in the capital adequacy. we look across all the risks, and actuaries who've had experience in insurance would find many of the principles applicable, different risks, different issues, but the same general idea in assessing capital adequacy. So these are 6 areas where Michael and I know actuaries who are working, in some cases have been working for quite a number of years in banks in different countries. I mentioned at the bottom, we're participating in a webinar next week when actuaries who happen to be, in this case, from the UK, South Africa, and Australia, and have worked in these areas for years, will talk about these 6 examples of transferable skills. So let's just think for a minute what skills are required. If you are interested in moving into banking, what skills would the banker expect you as an actuary to have? In terms of product pricing, you start with DCF methodologies. You may apply more complicated techniques as well, but the tried and tested methodologies are the first level used by many banks. Model development and validation. To repeat what Mrs. Sevkin said about 160 models, large banks have lots of models. This is a very large part of managing the banks. Understanding of enterprise-wide risks, a language we use so much that our training encourages us to see across the whole risks in the organization. We may not be a specialist in every risk, but we understand the need to bring all these risks together. For the last bullet point here, when we're looking at the capital liquidity submissions, we're not just complying with regulations. We need to understand the risks and apply judgment or provide information for the board to make judgments about the capital and liquidity. So these are the sort of skills I found were useful as an actuary in my 30 years in banking. Then we need to have broader skills as well. I think that is a general issue in moving from insurance to banking. You need to know about accounting, you need to know about economics as well as about banking. The first thing we require in banking is to know about the language of banking. The credit, liquidity, and other risks we're familiar with, but the language is different. So it's not a big technical challenge, but in my first year in banking, I found getting up to speed on the language was a practical challenge. Then there's working multidisciplinary teams. Many actuaries are familiar with working in actuarial teams. Working in a bank, I found it really good, really helpful to be working with experienced bankers who really knew about credit risk or other risks, with accountants, with lawyers, with IT specialists, with HR specialists, internal audit, all kinds of people. So depending on the project, you would normally work with people. So actuaries would typically be working with accountants, with machine learning specialists, with other risk professionals. And I find it very rewarding to be part of a team. Actuaries can bring some skills and experience, other professionals can bring other things together. It makes for strong teams. On the third point, actuaries sometimes are very long-winded about technical matters. I found in a bank, my boss always wanted to know the answer. What did it mean for the bank? What should we do? Rather than getting bogged down. So getting to the point was important. And then if my boss wanted more information, I could give it. And then as an actuary with a professional code, there is the matter of raising constructive challenge. It's very easy for groupthink, for optimism to creep into any organization. So it is important that actuaries have training and know how to raise challenge and concerns, of course, in an appropriate way, at an appropriate time, not to be seen as troublemakers, but to be seen as constructive challenge. So these are the broader non-technical skills that I found were required or useful. Then to end quickly with 3 things we can do to help you. If you are interested in banking, then we have a glossary of banking terms, because this is, as I say, the challenge I found the first year. I wish I'd had such a thing to look at before I went to meetings. It's very straightforward, very easy to read, but just means if you were going to talk to a bank, you can talk in their language. And when you work in multidisciplinary teams, it's very important to talk in banking language, not in actuary language. Secondly, Michael put together with me and a number of other authors a paper about banking. This is a paper for actuaries, talking about things that actuaries are interested in. It's less than 100 pages. I think it's pretty easy to read, and it focuses on the topics that actuaries would be interested in. So it's not as comprehensive as Mr. Sevgin's overview. It focuses on areas that actuaries would want to work in if they were in banking. And the third thing is that if members in Turkey really wanted to have a career in banking as I've had, the South Africans have had for a number of years banking courses, and the IFOA and ASA worked over the last year or two to separate their single course into principles and application course. As you see, the principles course focuses mainly on the measurement of risks. The headline chapters are the main risks that Mr. Sevgin mentioned. Obviously, there are sub-risks within these chapters. The right-hand side is a more unusual course. There are equivalents to the left-hand side by many bodies, but the right-hand side is more unusual. How do you manage these risks? Much the same list as the left-hand side, but as well as the various risks going on to governance and strategy, as well as managing the risks. So thank you for your attention. I'll pass the floor back to Michael.
Thank you very much, Ian. And once again, you have highlighted and illustrated the areas that actuaries can be involved in within the banking space. So that's very good, and thank you very much. I hope all the attendees here are paying attention so that they can understand how they can actually enter into in the banking space and convince Mr. Sevgin to hire them. You know, that's really what you need to do with the skills that you already possess. So thank you very much once again, Ian. And I think we've spoken about this many times at many webinars. Excellent speech. Now, I want to take between 5 to 8 minutes, also just talking about what has happened within the Actuarial Society of South Africa in terms of leading banking practice for actuaries. I will also include places like Australia that are also a bit ahead, because we recognize that different countries, like Turkey, for example, are at different levels of development in terms of bringing actuaries into the mainstream. So my story covers about 14 years, right? So like I said, 5 to 8 minutes. I'll cover that in 5 to 8 minutes, 14 years story. It started in 2008. I moved in banking in 2008, worked for Nedbank here in South Africa. I was in the real estate team or property investment banking division. When I was there in 2008, when I moved in, just like Ian, also I got confused with terminology, but because of curiosity, I started to understand what's happening. In 2009, we realized that there is a group or a large group of actuaries who were already in banking, but they were not represented within the profession. So we motivated as a group, and I led that motivation to the Actuarial Society of South Africa, to the council, to the then council, to say, we need to recognize banking as a practice area. What then happened is we formed a task force. I chaired that task force in 2009. We made our recommendations. In 2010, we established a banking committee. I chaired that banking committee until 2017 at the end. Right, once the banking committee has been established, it means we now recognize banking practice as a formal area of actuarial practice. Why did we have to do that? We found that there were about 150 actuarial professionals working in banking and not represented, nothing happened. Between 2010 and 2012, all we were now doing is we were doing webinars. We were, mainly webinars, sessional meetings, just to discuss about what actuaries are doing in banking, bringing different speakers. But at the same time, we said, but there is no education material for actuaries in banking. So in 2012, we started talking about education. Let's have some material for education. At the same time, Basel II had just been introduced in 2008, I think 1 January 2008, and we found the South African Reserve Bank also saying, if you are adopting those advanced internal ratings-based models, it is best that you bring actuaries so that they can validate and check your model. So the Reserve Bank itself, it was not a regulatory requirement, but they were recommending that you do that. So you found all the 4 top audit firms now had to employ actuaries in the banking space. So teams of actuaries working insurance and banking. So most of them became specialists in both areas. So that was happening during that time. 2013, what happened? We then said, look, now it's time to do this banking subject. But we also faced challenges by other actuaries in other areas saying why actuaries do not have the skills to be in banking. So there were challenges, but we had to convince them because that is what was happening because they worked in other areas. They had no insight. So we convinced them eventually. And then authorization was given to bring the new first banking subject. We wrote the notes with one world-renowned professor based in the UK, Professor Murad Chaudhry. So we wrote those notes and a few other professors, and I was leading that team. 2015, we introduced the first banking exam. Throughout this process, what separated, what made progress happen is because of the leadership of the Actuarial Society of South Africa, because they were taking recommendations we were giving them. Because we were actuaries in banking, we knew what was happening, and we could see the skills we were applying that they were applying. So 2015, first sitting, no one passed that banking subject. And obviously, and it's new. Then from there onwards, I think we were now really just, that's when we had our inaugural banking seminar through the banking committee in 2015 and introducing the subject at the same time. Whilst we are there, the next ASAP banking seminar is on 29 September. So if anyone wants information, we will share 29 September. It's a whole day, but it's online as well as physical. From there onwards, fast forward to 2020, 2021, we entered into partnership with the I4A. So the subjects you have seen that Ian Allen just showed there, those topics, the principles and the application subject. We revamped our original subject of 2015 and we split it into 2. Now it's being offered internationally. So things have moved since 2008 when we raised this issue and I was leading the whole issue. 2016, I was appointed as chair of the IAA Banking Working Group, which is now called the IAA Banking Forum, right? Because of the work we had done in South Africa to now try and promote the involvement of actuaries in banking. So it was quite a journey and it was being driven from the South African perspective, but we did not forget the fact that there's Australia. So we worked with the Australians. There's a gentleman called Stephen Clarkson and a few others. We are actually presenting at the European Academy of Actuaries next week on the 22nd. Again, you can join that. Stephen Clarkson will be there. So these Australians, we worked with them because they also had a similar number of actuarial professionals in banking. So we did not work in a vacuum. We worked with everyone and we went ahead to share that knowledge and information with the rest of the actuarial professionals around the world. And in that process, that's when I met people like Ian Allen, Dr. John Young, and many others who were already in banking, but also realized they were not being recognized by that actuarial profession. So I would like to end here. It was a journey. I was involved a great deal, and then many other actuaries came and got involved in driving the ASA strategy for recognizing banking as a practice area for actuaries. With that, I would like to end there. Like I said, 14-year journey, but I can only do it in 8 minutes given the time that is allocated. So I would like us to go to any questions that attendees might ask or might have asked. But so far, we don't have questions from attendees here, but we've got questions that have been asked in advance, and these are being they are being asked directly to Mr. Sevgin, whilst the rest are still thinking about questions to ask. I'm going to ask Mr. Sevgin some of the questions that are directed at you. The first question is, what have you enjoyed most about banking in your long and successful career at East Bank? So that was the first question that was asked. And then the second question was, approximately how many people work in risk management for East Bank and what do they do? So those are the two first questions I would like to start with that I'm throwing at you. Thank you very much. The floor is yours.
Thank you. So there are many aspects. After working more than 30 years in our bank, in the head office and branches in Turkey and abroad, I can say that banking is a multifaceted industry that can provide rewarding careers. Banking, like many finance jobs, involve long hours, stressful work, and high levels of commitment. Working for a bank requires a combination of quantitative and social skills, plus a sound knowledge of current economic events. You can also interact with customers of all kinds and at all levels. Banking provides also the great opportunities to meet, work with, and serve people from all segments of society, each with their own needs. I work with passionate and talented people. In East Bank culture, we are working with common mind, consultation, dedicated, and voluntary work style, as I can say. For the second questions, I can say that currently there are more than 50 people is working in the risk management division in East Bank. In Turkey, over the last few years, the importance of risk management functions has increased significantly. After 2016, BRSA has published more than 15 best practice guidelines in accordance with ECB standards, and now expect systematically important institutions like East Bank to fully comply with these principles. Also, risk management divisions are expected to assume the responsibility of ICAP and recovery planning processes of the banks. Hence, the number of people working in the division will continue to increase. I can say that.
Thank you very much. So important points that I've picked there, social skills that are required for you to be able to work in an environment like that, communication skills. These are also these very same skills, normative skills that we encourage actuaries to have in any environment. So there you got it, actuarial professionals. You need to have very good social skills, very good communication skills. You need to understand the business model of a bank. Like Ian also said earlier, you need to understand the terminology so that you can plug in and be able to work with others. And thank you very much, 50 people in risk. That's excellent. That's a good number. So that's actually excellent. And we hope that we will see a few actuaries joining those risk teams so that they can do some of their work. Now that we don't have any other question again, Mr. Sevgin, I hope you won't blame me for asking these questions that have been sent in advance. I'm going to ask two more questions. When you are recruiting people for risk management in banking, what are you looking for? That's question number one. Question number two is that in some countries, banks have been considering climate risks in stress testing exercise. Are Turkish banks also starting to consider climate risks? I think that's a point you touched on earlier. but we are asking the question again. Thank you very much. The floor is yours.
Thank you for the first questions. In risk management division, several analytical tools and models are used for analyzing the data and for quantifying and reporting the risks. So I can say that the main qualifications that we require are having strongly analytical skills, having knowledge or ambition to learn programming languages like SQL, SAS, Python, R, etc., and having experience in modeling techniques, data analysis, and reporting processes. So we prefer people with engineering, mathematics, or statistic background, but there are many people with business and economics majors in our team as well. For the second questions, sure, as is bank, we have already begun to take into account climate change risk within our risk management framework. We have defined the climate change risk and its sub-risk types like physical risk and transaction risk in our risk taxonomy. We are regularly assessing our loan portfolio to have a high-level view on the sectors or segments that are influenced significantly from this risk. And we are creating a heat map of our loan portfolio. Using this heat map for the sectors that are highly exposed to climate change risk, we are performing scenario analysis to measure the impact of risk events like emerging carbon tax regulation or decrease in precipitation, etc., to the probability of default PD and expected credit loss ECL figures on the loan portfolio. What can I say, for instance?
No, thank you very much. There you go again. Exactly the areas that can be the areas actuarial professionals who are here listening can participate in. So thank you very much, Mr. Sevgin. I think this has been great, your presentation, and then you answered those questions. I would like to reach closer to this webinar, but before I do that, I would like to give an opportunity to all of you panelists, if you have got any closing remarks or closing words that you'd like to say before we come to the end. So I'll start with you, Ian, and then I'll go with to Shezat, and then I'll go to you, Mr. Sevgin, and then we can close. Thank you.
I think I would just repeat from the IAA Banking Virtual Forum that we have a lot of actuaries in many different areas in many different countries who have good experience in banking, are very nice people, and be very willing to help. So if the Actuarial Society of Turkey would like more information on a particular topic, we'd be very happy to help you and be very happy to put you in contact with people who have particular expertise in your areas of interest. For example, Mr. Sevgin talked about moving from a standardized approach to internal models. If you are going to work in that area, we can provide help or liquidity, whatever. So if we can help you, please don't hesitate to ask us.
Thank you, Ian. Shezat.
Actually, thank you very much, Mr. Sezai, Ian, and to you, Michael. Actually, my last words, actuaries have different skill sets and they can work at any area related with risk and uncertainty. So let's just encourage to our colleagues work different areas. Thanks. Thank you very much.
Thank you very much, Shezat. So I finish with you, Mr. Sevgin. Any concluding remarks from you? Thank you.
Thank you very much again for inviting me, and I wish success to all participants. Thank you.
Thank you very much. I would like to thank you all for attending this webinar. This has been great. I think at least we've got some basics of understanding what actuaries are doing in banking. Everything that Mr. Sefkin has been saying is exactly some of the work actuaries are doing. There is a question that was asked, is how many actuaries in banking around the world? We don't know the number. I can tell you in South Africa, it's about 600. In Australia, it's also about that same number, around 600. But I cannot tell you around the world because we have not collected statistics. Apart from saying there are a lot of people who get interested in that. That's about it. I would like to call it off. I would like to thank Nancy and Amali once again for arranging this webinar, and thank to all of you panelists and to all of you attendees. Until next time, think about the ASA Banking Seminar, 29 September, if you want to attend. Then the European Actuarial Academy on 22 September, if you want to attend. We will share the information. Thank you very much. Bye-bye.
Thank you. Bye-bye.